Hey, my name's Rajesh. I am a direct lender based in Los Angeles, California, and today we'll be discussing LTV. What is it and why does it matter? So LTV. LTV stands for loan to value. And value means purchase price, or appraised value. And loan is equal to loan amount. Another way to write this is as a ratio. So you have loan, value. Another way to write this is loan over value. And another way to write this or express this is as a percentage. So let's say you have a value of $1 million. And you have a loan amount of $300,000. Your loan to value is equal to 30%. See? Loan value on the bottom is equal to percent. Loan value percent. And so we're going to talk about how this is determined for different types of loans. We're going to talk about first government loans. Then we're going to talk about non-QM loans. And back in 2008, this was called subprime loans. And then we're going to talk about hard money loans. And sometimes they go with the label private money loans. Private / hard money loans, subprime / non-QM loans. And then we have government loans. Now, if we go back to 2008, government loans were also subprime loans in that they were accepting and backing loans that did not meet standards that they were required to meet post 2008. So pre 2008, you could qualify for a loan, for a government loan, using bank statements, and stated income such as P&L, profit and loss statements. Oh, you could also use 1099s. But now the only things now these days, these are called non-QM loans, non-qualifying mortgages. To be a qualified mortgage, you need to have tax returns, W-2s, or, and this is the key word here, a written verification of employment. That means your employer fills out a form verifying that you have worked there for a set period of time and what your wage is, what you get paid every month. So those are qualified mortgages. So for qualified mortgages, there are FHA loans, VA loans, USDA loans for rural areas because not every rural area that they are willing to fund in is truly rural, and conventional loans, or Fannie Mae and Freddie Mac loans. So these are conventional for first-time home buyers. their LTVs go up to 97%, and for non-first time home buyers, their LTVs go up to 95%. For USDA loans, they actually go up to 101%. For VA loans, they go up to 100%. And FHA loans, that means they go up to, for FHA loans, they go up to 96.5%. So what does that mean? When you're buying something, buying anything, there are only two ways to pay. And the only two ways to buy anything, I'm talking about candy bars, I'm talking about cars, I'm talking about books, I'm talking about homes, I'm talking about businesses. The only two ways to buy anything is with equity and debt. So equity is cash, stock, other contributions already belonging 100% to you. Well, let's just say already belonging to you. And debt is borrowed money. So let's see this example in real life. Let's say you go to a car dealership, and here's your rusty old car, and now you want this new car. So what you do is trade it in, but you get the fair market value or a discounted rate on this car. Let's say it's worth $10,000 and this car is $50,000. So you go to the dealer, you trade it in, and now you only owe $40,000 on this car. The car is still worth $50,000 while it's still on the lot before you drive off. It's a depreciating asset, but that's besides the point for this example. Your car is worth $10,000. The new car is worth $50,000, or it costs $50,000 rather, and you trade it in. So you're giving $10,000 not in cash, but in a car, something you already own. And now you just have to come up with $40,000. You can take $40,000 in cash, but more likely you are going to take it as $40,000 in debt, either from the bank their pillars, or from the dealer. And there's the car salesman mustache right there with the big bow tie, because that's what car salesmen look like in the cartoon world. So you either get it from the bank or you get it from this car salesman, and then you have to pay it back. You're sort of paying that money back with interest, plus interest. So those are the two ways to buy anything. Now you can also put down $10,000 in cash. You can put $5,000 in cash and get a debt of $45,000, but you are using a combination of equity or debt. Now, you can also put down $50,000 cash, that is totally cool. Now you don't have to get debt because 100% of the purchase price is coming from equity, not debt. But when buying expensive things, usually it's a mix of the two. Now, this also applies to businesses. So when Facebook bought IG, Instagram, they paid $1 billion. But they did not pay $1 billion cash. Instead, what they did was they said, here's some cash and here's some stocks. They paid 100% equity for this and zero debt, but they did it by doing some cash and some stock. And you're wondering, well, who would do that? This is 100% equity, and this is a sidebar, but let's say they did 10 million cash, or even 100 million cash and 900 million stocks, right? Well, a year from now, because of inflation, this is only worth, even at 2% inflation, that means this fell in value 2%. So now you're at 98 million cash, assuming they put it in a vault and never touched it. And these stocks, because of appreciation of the business and business fundamentals and even inflation, again, assets go up in price because of inflation, just like a normal orange or pear or apple goes up in price over time because of inflation. This is now worth, at 2%, this would be 902 million in stocks. But because of business dynamics, this probably went up 10%. So now this is worth $990 million in stocks. So, but they were still paid in equity ownership. How does that apply here? So LTVs means this is the loan to value. This is the loan amount. What the borrower or buyer has to come in with or gets not to come in with in terms of maximum loan amounts. In terms of equity, on an FHA loan, a borrower has to bring in 3.5% down payment. On a VA loan, 0% down payment. On a USDA loan, again, 0% down payment. And on a conventional Fannie Mae, Freddie Mac loan, you're looking at between 3 to 5% down payment in equity. Okay? And yeah, they had to come in with closing fees and origination fees and appraisal costs, the closing costs of the loan. That's besides the point. When it comes to actually buying the thing, what they have to pay for towards the purchase price is this. This is what's going to the seller of the property, a combination of these two things. This is what's going to the seller of the property. The other cost, the closing cost, is what's going to the lender. That is the cost of money. But let's talk about, that's QM mortgages. Now let's talk about non-QM mortgages. Non-QM mortgages are usually between anywhere from 75% to 90% LTV, depending on whether it is an owner-occupied home or an investment property, and whether it is more than 4 units or less than 4 units. So that means the borrower has to come in with anywhere from 25% down to all the way up to 10% down equity. And these two combined, when you add it up, just like you did here, plus, 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 equal to 100% of the purchase price. Purchase price, purchase price, purchase price, purchase price. And when you add these up, you get 100% of the purchase price. Okay? Now, when it comes to hard money loans, depending on whether it is a first position lien or a second position lien, you're looking at up to 65% LTV. But that's on the max side. LTV. If you're looking at a piece of vacant land, it could be as low as 25% LTV. So that means the borrower has to come in with anywhere from 75% equity or cash to 35% equity or cash. And this also goes for refinances, but we'll get into a different video about, I'll discuss refinances in a different video. This is, again, first position. First position, lien position. Let me go ahead and position. First and second is perhaps up to, some hard money lenders are willing to go up to 65, but more likely they're willing to go up to 55% LTV. So, whoops. So let's put that there. Let's put a slash. And on the minimum side, some lenders just refuse to do anything. So you're looking at 0% as a second position lien. That just means there are two loans on the same property, and the loan in the first position, or the debt in the first position, if the home has to sell, this one gets paid off first, this one gets paid off second. If there's something in the third position, that gets paid off third. When it comes to something like property taxes, that's in zero position. Zeroth position. Or more realistically, that is pushed to first position, and this becomes second, and this becomes third. So these are taxes, property taxes, government taxes. So that's why lenders are reluctant to lend money to borrowers who have tax debts. But these are the different amounts for the different loan classes. The question is, why? Why? If the VA is willing to lend up to 100%, why is Fannie Mae only willing to lend up to 95% or 97%? If the VA is willing to lend up to 100%, why is the FHA only willing to lend up to 96.5%? And if all of those qualified mortgages are willing to lend above 95%, then why are non-QM lenders only willing to lend up to 90%? Right? And if non-QM lenders are willing to lend up to 90%, then why are hard money lenders only willing to lend up to 65%? And that's what we are going to get into in this video. So let's see, QM up to 100%, non-QM up to 90%, and hard money up to 65%. The question is, why? Well, what is a QM mortgage? A qualified mortgage is a mortgage that meets certain standards set by the government and is bought by the government. It's bought by Fannie Mae, it's bought by Freddie Mac, and it's backed and it's got insurance backing from the US government. So that means if these loans fail, the government will cover those losses to the lenders and to the buyer of the debt, which in this case is Fannie Mae and Freddie Mac, which at the before 2008 was a quasi-government agency, post 2008, post 2009, post Dodd-Frank is a government agency, and they're now in talks about making it private again. But the reason for that 100% backing is that if the borrower fails to pay, then the loan itself is fully covered thanks to mortgage insurance. Mortgage insurance in the case of FHA loans, and in the case of a Fannie Mae Freddie Mac loan, it's covered by private mortgage insurance, assuming that your equity was less, or equity was 20% or more. Your down payment was 20% or more. But regardless, even without that, as in the case of VA or USDA loans, you still have the full faith and backing of the US government. You got the bailouts. Just like what happened in 2008, the government bailed out all these lenders who made loans according to what the government would accept at the time. Post 2008, the government set different standards, and as a result, loans that were previously qualified became non-qualified, and they became non-qualified loans. Now for these, there are still buyers, but these buyers are institutional, not governmental. Let's say there's a government buyer here, government buyer. And these have non-government buyers. For these loans, you have JP Morgan, Citibank, Wells Fargo. So you got the big banks buying these, but you also have insurance companies. You have MBS. These are bought and split up into shares, mortgage-backed securities, as packets, and sold on Wall Street as individual shares. You also have, what was the word I was thinking of? It slipped my mind. You have pension funds buying these because they pay dividends, or they the money collected on the interest rate serve as dividends rather, and they also continue to go up in value as they're resold. As interest rates drop, mortgages with higher interest rates become worth more by definition because they pay out. The payout is higher. So you have these different institutional buyers for these types of loans. These are government bought and backed, and these are non-government bought and backed. Hard money, on the other hand, has buyers, but they're generally considered riskier loans, and they're bought by sometimes the same group of people, but they're bought at a bigger discount because their underwriting process is less about borrower and more about the asset. So hard money loans equals asset based lending, and qualified mortgages are borrower based. So that means they're looking at their credit score. They're looking at their debt to income ratio because they want to ensure their ability to repay the loan. And assuming this is good and meets their standards, they will get up to 100% of the loan amount or the purchase price as debt. Non-QM is somewhere in the middle. They're between qualified mortgages and they're between hard money mortgages. And as a result, they look for both this, the borrower, and the asset. But hard money, and when I talk about that, let's say a DSCR loan. A DSCR loan is essentially looking at both the borrower and the asset. So they're looking at a credit score, but they don't really care about the borrower's income. They do care about the borrower's credit. They want to make sure that this borrower is somebody that pays their bills. So they're going to look at 680 plus for a DSCR loan, and for commercial properties they're going to want a minimum of 700. So 1 to 4 units, 4 units, and these are 5 plus units. Okay, and then they're also going to look at the property or the asset, borrower here, borrower FICO, property. Now the property is the one that has to generate income, so they're going to look at gross rents. And when they look at gross rents, they're also going to have to look at debt service. So whereas on a government-based loan, the DTI, debt over income ratio as a percentage, here what they're looking at is rents over debt as a number, as a DSCR ratio, and they want that to be equal to 1.0x, or 100% DTI, but the debt to the income is based on the building's income, and the debt is based on the building's debt, not the borrower's. But they're still looking at the borrower based on their credit score. They don't care about the borrower's income on an investment property when they're using the rents to qualify. They are looking at, however, the borrower's credit history. When it comes to owner-occupied, they're looking at bank statements. So let's say I show $1 million deposits every month in my bank, even though on my tax returns I show 0 income. My bank statements show that, hey, I'm a safe borrower. So that's a verifiable third-party source. It's just not a third-party verifiable source good enough for governmental income for a qualified mortgage. And then we have 1099s. Let's say you're an Uber driver, or you're a freelance accountant, or you are a real estate agent. You will probably be getting 1099s. Now on your taxes, you're probably writing off all these expenses. And if you're like most Americans and most middle-class Americans, you're probably also writing off more than you're allowed to, or more than you actually have, even if you are allowed to. So let's say you're earning $120,000 a year as an Uber driver that works 24/7, and you write off the car expenses, the gas, or the mileage. You're writing off the depreciation of the car. You're writing off the maintenance costs of the car, and you write off $100,000. Now you only have $20,000 in income, and so that's not enough to qualify based on your tax returns for a QM mortgage. But in reality, you're actually you only have expenses of $30,000, and your actual income is $90,000. So we're going to use a 1099 to prove that you have income. Again, a verifiable government third-party source. We might also use P&L statements. So let's say you own a business. Same basic idea. If you own a business, you're probably writing off a lot of things on your tax returns, including depreciation and amortization of loans and debt and assets, to reduce your total net income so that you can pay as little tax as possible. But in reality, you are flush with cash at the end of every month, and you're able to afford to make mortgage payments based on that. So that's when we look at that, we're still qualifying the borrower. The point is, we are qualifying the borrower and the asset. On a government loan, they don't really care about the asset. Yeah, they do an appraisal to make sure that it meets certain standards. That on an FHA loan, that the septic tank is a certain distance from the main building and from the absorption field. That the building's in habitable condition immediately. That the borrower doesn't have to wait 6 months to move in, basically, while repairs are done, unless they're getting a special type of loan designed to repair the house before they move in. On a non-QM loan, they're doing the same basic test, but they're using looser standards to qualify the borrower. On a hard money loan, they just don't even care about the borrower standards. They could have no credit score, no FICO. They could have zero income. All they care about is the asset. And asset equals home. So no mid-construction projects, just like you would with a government loan, no mid-construction projects. You would also care about location. So location, which affects appraisal value. So for example, a one-bedroom shack in central LA, in central Los Angeles, a shack, let's say this one-bedroom shack in LA is equal to $1 million, and in Lancaster, in Yucaipa, is equal to $200,000. The same shack. So I'm going to just duplicate it, and that way you get the same shack. That shack in $1 million in LA is worth $1 million, and that same shack in Yucaipa is worth $200,000. So location affects appraisal value. It's the same asset, just in a different location, but the earth underneath is part of the asset itself. And now, as a result of this, right, we're going to base our LTVs. And remember, there is no government backing these loans. So based on that, why do you think that that the hard money lender is going to give you less loan and demand more equity from you? And the answer to that is risk, but not risk of the borrower failing to pay, because again, we know the borrower is going to fail to pay on a hard money loan. They have zero income. We've not verified their income. We don't even look at their credit score. So some borrowers are going to pay and make it. In fact, most do, otherwise there would be fewer hard money lenders, but there are some who don't. And the risk is not on the borrower, but rather the asset. Because in LA, if property values fall, right, let's say they fall 10% down to $900,000, and your LTV was let's say 95%, as it is with the conventional loan, or 100% with the VA loan. Well, now when you get the property, you loaned $950,000. But now you got to sell the property for $900,000. So as the lender, you're still losing $50,000, even though you were able to foreclose on the property. And that's just the property. You got to spend money to foreclose on the property. It's a legal process, so you're losing interest payments on 90 days worth of payments, because that's how long it takes to foreclose or that's how long it takes before you can issue a notice of default. and foreclose on the property. So it may take anywhere from 3 to 4 months, if not longer, to actually get the property back in your hands. Meanwhile, that there's a legal process that's costing you legal fees, and you've lent $950,000 on this property, but when you get it back, the property value has fallen, and you're stuck at $90,000. In a rural area or a place like Yucaipa, that means, let's say 95%, that means your loan amount is roughly 95,000, 190,000, right? Your loan amount is 190,000, but it's dropped 90%, so you're able to only recover $180,000, and that's assuming you're able to sell it and at 180. Okay, so whether you're in LA or you're in Yucaipa, this is assuming you get the full sales price after property values have fallen. What really matters is not whether property values have fallen or not, it's the gun to the head test, or sell in 30 days test. So the issue is, you get your hands on $1 million property, right, that you put up $950,000 for. In 30 days, how much can you sell it for? Let's say you went through the foreclosure process, or the borrower was nice and said, yeah, you know what, I cannot pay this mortgage bill, I'm moving out right now. And they just give up the keys to the property to the lender, so it doesn't cost you anything beyond the $950. Forget the other lost costs of the building. Why sell in 30 days? What is this gonna, how much can you get for it if your time limit is 30 days? And you're wondering, why don't they wait 60 days? Why don't they wait 70 days? They got to pay property taxes. They got to pay maintenance. They probably got to pay security security costs on there to make sure squatters don't move in and evict them later. Because if squatters move in and evict them because the house is sitting on the market too long, sitting empty on the market too long, squatters are going to move in, and then it's a legal process to evict them. So when they foreclose, they want to sell it as soon as possible. One. Two, they're not in the business of maintaining properties. Lenders, we are not in the business of maintaining properties and collecting rent. It's a whole different skill set. And let's say I buy $1 million property, I rent it out, and I get $10,000, or more realistically in Los Angeles, $3,000 to $5,000 a month in rent. After all my operating expenses, which includes insurance and property taxes, I'm left with maybe $1,500 a month. Well, as a lender, just on the origination fees, I'm not even talking about on the interest collected over the lifetime of the loan. I'm just talking just pure origination fees. I can realistically clear $15,000 to $20,000 in 2 weeks, because that's normally how long it takes to start and close a loan on a hard money loan. And if I do that, I'm making $15,000 to $20,000. That's 10 times my net profit or cash flow on rent. So why would I wait or take possession of a property when I can just close one property and make 10x the amount of money that I could on a rental property? It just does not make sense to me, and it does not make sense to a lot of other lenders. So they don't want the property, they want to get rid of it. The property is a liability, not an asset. The property is an asset for the borrower who owns it. The property is an asset for the investor who's renting it out. The property is a liability for the lender who wants to sell it and recollect their money so that they can lend it out again. Because every day that money is sitting in the property and not in their bank account, they cannot lend it out again. So they want to give you they don't want to give you a discount. They want to give themselves a discount. So when they say LTV is 65% of $1 million property, they're saying they're willing to put up $650,000 out of $1 million. That means the borrower is putting up $350,000, and let's say 1 million, and let's say the borrower defaults, right? And now you got to wait the and the monthly payments, let's say the monthly payments are at, I don't know, 12% interest. So they're going to be making, let's see here, 650,000 times 0.12 divided by 12, 6,500 a month. 6,500 a month. And the borrower misses that, right? So, and it takes 3 months to foreclose, so 6,500 on interest, and this is interest only, or IO, times 3 is equal to $19,500 that the lender has lost because the borrower has not paid. And then there is the judicial process. Let's say that hiring the lawyers and going through the court system to foreclose and get the borrower out, that process, let's say it takes $10,000. No, let's be even more exaggerated, $50,000. So now this $19,500 plus the $50,000, they are out $69,500. And that's not even counting if property values fall. So let's say property values also fell 10%. So now the property is worth $900,000. So you've got $900,000 minus the $69,500 that you lost as the lender, that the lender lost. So there's almost 70,000. We are looking at 830,000. So 830,500. So that means the lender has to sell this property at $830,000, or rather, let me see how to phrase this. So yeah, this property now, if the lender sells it at $900,000, they are getting $830,500. So that means that is actually an 83.1 or 0.5% LTV. And remember, the government loan was up to 97% LT or 100% LTV with FHA and USDA loans, with VA and USDA loans, with FHA loans 96.5%, and with Fannie Mae Freddie Mac loan for a non-first time home buyer up to 95%, or 950,000. This is 965,000, and this is 1 million. So if these government agencies had to foreclose on this same borrower for non-payment, and then they sold that property in the same conditions, which is a declining market, and it costs them the same amount of money, lost payments of $19,500 and $69,500 and $50,000 in lawyer fees, or a total of $69,500, they're walking away with the loss of 830 let's see, 1 million minus 830.5K. So let's see what the loss is here. 830, or let's see, 123 minus 830.5. So they're walking away with $169,500 K loss. So the hard money lender, however, in this situation actually ends up making money. So they walk away with $830,500 minus $650,000. Whoops. 830,500 minus 650,000. They're walking away with $180,000 500 in profit for the hard money lender. So they're essentially giving themselves a discount. The 65% LTV for a hard money lender means that they are getting a 35% discount on the property if borrower defaults. And they're also making money on the interest because in order to pay off the loan, the borrower has to improve their credit, improve their income, and then refinance it in order to pay off the lender. Unless they are just earning so much cash and they're just going through a rough period of time or they need cash for a business investment and they fully expect to come out of it, and they just pay off the lender, the hard money lender, in cash. So that's the reason for these discounts. That's the reason why LTVs are low on hard money loans. On a government loan, while they're losing $169,500, this is what's actually paid for by mortgage insurance premium on an FHA loan. So that means the government backing the lender or the buyer of the loan, in this case Fannie Mae, Freddie Mac, says, hey, yeah, so that person defaulted on their loan, property values went down, you spent this much getting it back, and you resold it at auction for $830,500 in order to recover your money. So let's say in order to cover your losses, we only had to pay you $169,500 or $170,000, and in order to recover what you lost. So they're only paying out the losses there, and this is collective. So you've got millions of Americans all paying mortgage insurance, just like in health insurance, and it's the sick or it's the defaulters, the non-payers, who end up costing the rest of the people money. Let's see where to go from here. I don't know if my thoughts were the most organized, but I hope this helps you understand why hard money lenders and why different types of loans have different LTVs. Because even in the case of government loans, qualified mortgages, even though they have higher LTVs, they still have different ways of recovering their losses and to make sure that they don't just lose their money. As a lender. Let's see here. What else? We've got the 65% LTV. Oh yeah, and so you've also got the 30-day test, the gun to the head test, right? So let's say you foreclose on a property. It's worth $900,000 in this market. If you try to sell it for $900,000, are you going to get $900,000, or is it going to sit on the market? Depends on the condition of the property, depends on how buyers are feeling in the neighborhood, etc. But you take that same $900,000 property and you list it for $830,000, which is, by the way, the bare minimum that you need to cover it. Well, maybe you still have buyers feeling it, maybe not. Depends on the neighborhood, depends on the economy, whether there's a recession or not. All of a sudden, you put that same $900,000 property for sale at $700,000. or let's say $750,000. Now you've got to line out the door for the property, right? So $750,000 you're selling, and you got it as a lender, if you remember correctly, $650,000 plus the $69,000 in cash that it took you to recover it, right? So now you're at $719,000 here. So you're walking away with roughly $31,000 in profit. You're still covered. Even though you're selling a home that was originally worth $1 million, and in today's market is worth $900,000, and you're selling it for $750,000 because you want to get rid of it in 30 days or less, you walk away with the $31,000 profit, with the $31,000 profit. And the only way you can do that is by limiting your LTV. So when borrowers come to me and they need hard money loans and they're like, can I get a little bit more cash? Can I get a little bit more cash? No, our LTVs are fixed. Our LTVs are fixed. And that also goes for government loans. So if you came to me for and you qualified for an FHA loan, a VA loan, I'm going to give you the max LTV that I can. Now, whether you want to put more money down or less money down, that's your decision. But treating it as if it's a product on a shelf, just as you would say an iPhone versus a Samsung versus a Huawei, it comes with fixed price tags. And so when you come to me for a VA loan, you're going to get 100% LTV, up to 100% LTV. If you come to me for an FHA loan, you're going to get up to a 96.5% LTV. If you come to me for a non-QM loan, you're going to get up to 90% LTV. If you come to me for a DSCR loan, you're going to get up to 80% LTV on a 1 to 4 unit, and on a 5+ unit, you're going to get up to 75% LTV. But if you come to me for a hard money loan, you're going to get up to 65% LTV. And the only way around this game is to increase the appraisal value. So let's say you have $1 million home and you've got it fully paid off, but you need $700,000 cash because your credit's crap and you've lost your job. So all you've got going for you is your home. You're going to get 65% LTV. That means you're only going to get $650,000 cash out as a refinance on it. Okay, so, and you need $700,000. So the only way to do that really is to get $700,000, divide that by 65% LTV. So let's see what that is. 700,000 divided by 0.65, and that is equal to $1.07 million. $1.76 million. So let's just round this up right here, and $1.08 million. So your property has to appraise for $1,080,000. That's what it has to appraise for. And the way lenders do this is they hire an appraisal management company, a third party, to hire an appraiser, because there needs to be distance between the lender and the appraiser and the borrower and the appraiser. The borrower cannot hire their own appraiser. The lender cannot directly communicate with the appraiser. And the borrower should definitely not communicate directly with the appraiser, because if that process is tainted, if the third party objectivity of the appraiser is tainted, then the appraisal doesn't mean anything. And we cannot get an objective value on the property. And that is not only a bad thing for the lender and the borrower, it is also bad in terms of legalities, because legally we need to get a third party objective appraisal of the property in order to lend on it. Now, some hard money lenders may choose to go borrower or broker price opinion, and some of them choose to just look at it themselves. And this is the case with hard money, not the case for non-QM and for, well, let me correct that. That's the case for investment properties. Even with hard money loans, when it comes to owner occupied, you better believe they're getting an appraisal on that. And this is again to meet government regulations. When it comes to investment properties, non-owner occupied properties, they can go inspect the property themselves and come up with an opinion by looking at comps and looking at Zillow and visiting the property themselves in person and saying and asking and talking to the neighbors and things like that. They might also just hire a local real estate broker with expertise in the area, or they might take their best friend along who is a real estate broker and can give them an educated guess on the value of the property, as long as with some comps, and put something in writing so that it's all documented. They don't necessarily need an appraiser for that. But when it comes to owner-occupied properties, because of Dodd-Frank, because of RESPA, because of TRID, because of Regulation Z, because of Truth in Lending, because of the 2008 crash, really, they're all going to get objective appraisals just to ensure that they're getting a true value. So the value might come in at 1.05, in which case they will get 65% of 1.05, or let's see here, 105 times 0.65, 682,500. Anyway, I hope that was educational and you understand what LTVs are, why they exist, and how that protects the lender, even in hard money loans where they do not care about your credit, where they do not care about your income. All they care about is the value of the asset themselves. And the LTV is basically the lender buying that property with their own cash or investors' cash at a discount, assuming they have to foreclose on you. So gun to head, worst case scenario, they had to sell in 30 days. How do they protect themselves? They buy the property at a discount so that when they have to sell it on the open market in 30 days, they still make money on their loss.